As we get started, please welcome with me the panelists for today, who are Dr. Jón Rosam from EY. We have Emma Landriault from JP Morgan with us, Peter Left from Lloyds Bank, and Jón Egilsson from Monerium. With that being said, the standoff is about stablecoins versus tokenized deposits, but there's actually more to be added to just these two words that are floating around the digital money landscape. And that would be sort of the first thing that I would like to ask you, Jón. Where do e-money tokens fit into this landscape?
Yeah, hi. So there is a standoff between stablecoins and tokenized deposits, right? I think it's a little bit unfair because stablecoins are, as we know, they are a proxy for money. They are not regulated money in Europe. So I think that's important too. There is no standard for how you safeguard. There is no standard on consumer protections in general. In Europe, we have something which is called e-money, and it's something that has been in existence for 24 years. And it's supposed to be technically neutral, and Monerium was the first company to get an e-money license to issue the euro on-chain, the digital euro. And it comes with a lot of responsibilities. There are certain ways that we are allowed to safeguard the underlying. There are very strict rules with regards to consumer protection. It comes with KYC, AML, and all those things. It comes with the burden of, we can safeguard in certain assets, high-quality liquid assets. It's defined. If it's going to be in a bank, we can do that, and the bank can then basically place it in a central bank. This is basically the money that the European Central Bank basically receives when they receive overnight deposits. So e-money is just regular money that we have on our debit cards, and it is now also available as a euro on chain. So there's a big difference between stablecoins and e-money tokens, and I think the debate or the standoff should be between e-money tokens versus tokenized deposits rather than stablecoins, because stablecoins are many things and ill-defined.
Well, we've already heard a little bit about stablecoins, so we're going to come straight to what you also mentioned, namely tokenized deposits. Emma, why don't you introduce us to that concept?
Okay. Oh, perfect. Okay, hi everyone. Thanks for joining us. Yeah, so I guess I will talk mostly today about deposit tokens. We'll start with kind of maybe developing a definition for tokenized deposit and then the delta with deposit tokens, just to kind of anchor the conversation of where we see it different, although there's quite a few overlaps, and I'm sure some of the other panelists will be able to dive into that. So ultimately, a deposit token refers to a demand deposit claim against the issuing institution for a fixed fiat amount that is owed to the token holder. The difference from an existing deposit is that it is in a token format. So from a commercial bank money perspective, this is commercial bank money like any other deposit. It's subject to the same sets of reserve requirements. It has the same sets of stress testing requirements. It would have functionalities like being able to pay interest, and has kind of this existing integration into the traditional banking system in the way that a generalized deposit would. However, it's in this token format, so it's more so held on, maybe what would be like an ERC20 standard token, so that we can issue these tokens onto blockchain environments and really exploit the benefits. Well, it's very important. So sorry, Peter. Yeah, nonetheless, so that we can exploit some of the efficiencies that DLT-based infrastructure can bring, things like enabling composability and programmability on these tokens, and to be able to have tokens that sit in the same environments as other types of tokenized assets would. Now, the minute kind of detail between tokenized deposits versus deposit tokens is that normally when we think about tokenized deposits, we think about a balance that's either immobilized or a pool that's sitting off-chain, and then we would be actually issuing kind of a receipt or a representation of a certain fractional amount of that pool on-chain, onto these DLT-based applications, markets, DLTs, et cetera. And then it can, trade and be transferred on-chain, but at the end, what it's really representing is the representation of ownership of this immobilized balance. With a deposit token instead, we just take the view that the token itself is the claim itself. So you're not actually holding balances that sit off-chain. You can kind of make, a similar comparison to like a tokenized security versus a security token. So a tokenized security, we're thinking about an off-chain traditional security. We represent it on-chain, and then it trades proportional to the fractional shares of that security versus actually just issuing a security token, right? Which is more so the security being natively issued to that token, attributed to that token and on-chain. Thus, deposit token versus tokenized deposit. I know this is so deep in the details, but I guess that's part of what we're doing today.
Certainly. Let's see if the audience will be able to keep up. If not, of course, happy, I believe, for all panelists. Fair to say you're happy to discuss after our panel as well. With that being said, let's come a little bit to that kind of framing that we're dealing with today, this standoff. That's kind of implying that there is some sort of competition, but is that actually the case, that these digital forms of digital money are actually competing with one another? Peter, what would be your take on that?
So I think Jón already mentioned it, that there's already competition today. There's e-money and there's deposits, and we compete. And there are different consumer protections and possibly different functions that can be associated with those forms of deposit today, or those forms of money today. And as we apply new technology, that's not going to change. I think what's important is that as we apply new technology, to both deposits and e-money, and perhaps other assets and potentially other forms of money in that spectrum, that we make sure that the consumer is protected and there's sort of a level playing field still, so that there isn't a way for someone to, offer a money-like instrument without quite the same protections as, we'd expect in terms of, consumer or small business use, etc. So very happy with the competition, but let's just make it a level playing field is probably my starting point, and why it's so important to have sensible regulation so that we can have genuine competition.
Jan, I wonder, is there anything to add from your side on the competitor question?
No, I think it's, as I was joking at the beginning, so we will need to get very technical on all the difference. But no, I think what Jón said is quite important. So when we talk about stablecoins, we talk about unregulated forms of money. And also when it comes to MiCA, we talk about actually e-money. So therefore, the comparison is unfair between stablecoins and, let's say, commercial bank money or tokenized commercial bank money. So I think from my take is, and I always say the same, from a consumer perspective, do you really want to deal with 10 different forms of money, or do you actually want to deal with one concept of money? So I think we had the panel before on stablecoins, which started very enthusiastic, but then came into the risk side, and where people also mentioned, of course, there is a risk behind the stablecoins, and I think therefore for consumers sometimes difficult to understand what's the risk actually I'm buying in. So it's clear for us, as we are engaged in this for many years, but we need to consider that the unregulated stablecoin carries risk. So therefore it makes sense to talk about regulated forms of money. And today's world, I mean, 60 to 80% of payments we do every day is commercial bank money. So therefore, I think it makes sense to think about, okay, what's the future of commercial bank money? So we need to talk about tokenized deposits, and also we need maybe to talk about regulated stablecoins, where MiCA forms a framework around this. So, and I think the key question, and I guess we will get into this, is how can this work together in an ecosystem? So again, because we had IKEA here, they have a multi-bank relationship. They don't want to deal with 10 different coins and tokens. So they want to have this as a unified concept in a regulated framework. So I think that's in addition, but I guess we get deep onto that.
I mean, you already mentioned some of the examples, and then there's also people and companies present here today that are already adopting different types of digital money, essentially, for their business operations. I'm sure you've met some of them already. So the question sort of also arises, what has been the level of market adoption, of real market adoption beyond the pilot phase so far in the various forms of money that you've discussed until now? John, why don't you start?
For use cases. Yeah, so I think before I go into that, then I think it's interesting to compare deposit versus e-money. I think that's really important to understand the difference. There's a big difference. So a deposit is where you have, deposit is a historical thing. In the old days, when we wanted to safeguard our money, our digital version of money, we only had one choice. We had to basically put it in a deposit, right? We couldn't put it on our hard drive. It has to be in a deposit. And that was a way for the bank to fund themselves in a cheap way. It was not because, it was a lack of opportunity to basically do it otherwise. We had to basically place it in a deposit. It was a debt on the balance sheet of a bank. And the counterparty was the bank. It's risky. A bank is in Europe is an institution which is leverage. It's about 10 times leverage. So you're basically lending your money into a bank because you didn't have the choice. In 2019, the Europeans got a choice. They were able to basically issue or hold their euros in a digital format on a blockchain. And you didn't need basically to place it in a bank. This is huge. So you asked about, what are the use cases that I'm really excited about? Those are the use cases that are supporting e-money tokens. And the project that was launched 2 weeks ago was the Gnosis Pay card, which is basically a Visa card, which is connected to a self-custodial wallet. And it is not, so the Visa card is connected to a self-custodial crypto wallet, not a bank. That's a huge thing. And why is it a huge thing? It is because the deposits over the history of banking has always been at the heart of the banking problem. 100 years ago, 110 years ago, we had a huge or large number of bank runs in the US. And how did the US respond? They basically established the US Fed, the central bank in the US, to basically say, well, we have bank runs and people are afraid about their deposits. So we create this institution, the central bank, to basically provide the lender of last resort to make it more secure. And then we have all kinds of risk mitigating measures that have been introduced. But still, 110 years later, we still have bank runs because people are afraid about their deposits. So I think it's a huge thing that we can now, as Europeans, we can have fully legit euros on a blockchain. We don't need to place it in a bank. We can boycott the banks, sorry for you guys, but this is a huge thing. This is about increasing financial stability in the system. And I say this as an ex-banker and as an ex-central banker. This is a huge thing. And this is the reason why we saw what happened in 2008 when Bitcoin was introduced. It was basically a way to basically solve the problems that we have seen in the banking system for decades. And it is all about deposits. So when I listened to, when I saw this title, the standoff between stablecoins and tokenized deposits, I was thinking, well, there is not really a standoff between either stablecoins or tokenized deposits because you are not competing with deposits. Deposits, you have much, as a consumer, you have much better alternatives. You can place your money in a money market fund, tokenized money market fund. Then you have not one counterparty, you have many, and you get better interest rates. So I don't see any competition with deposits, and I actually think it's probably going to happen, but I don't see this as a threat in any way, shape, or form. But I'm really excited about improving the banking system, and we do that through the e-money legislation, which is more than 20 years old, and it is now confirmed by MiCA. MiCA is not a new thing for stablecoins. MiCA is only saying, if you want to issue fiat money on chain and there's a claim on the issuer, then you have to be an e-money institution or a credit institution. That's all. There is nothing new about MiCA in my mind.
So can I come in? Yeah. So I largely agree. I think competition is actually a healthy thing, and it will help us all evolve to a better place. I just think we need to be really transparent with customers what they do and don't get. So I obviously biased, work for Lloyds Bank, big UK bank. I think the quality of our assets are exceptional, of course. And there has been learning over many years to have big liquidity pool, maybe something like 25% of the assets backing the liabilities are sort of reserves and high quality liquid assets in the form of bonds. And then yes, it might be customer lending. So it might be to help you buy your house or to help you buy your car. These are useful things for society that shouldn't be discounted at a whim. And the other 2/3 of the backing assets are actually over-collateralized because we have equity and bondholders that are bailed in. So you end up with that 60% that's backed by mortgages or credit cards or auto loans, are backed by 140% of those because of all the bail-inable collateral and the bail-inable resources from equity holders, equity investors, and bond investors. So I think it's not so cut and dry that it's better backing assets with e-money, and I think the choice is helpful. But I do think that then it's not just about the store of value. It is also about the consumer protections when you use these things. So if you make a payment with commercial bank money and it goes wrong, you get protection. If you make a payment with a stable coin and you send it to the wrong address, no one's going to give you the money back. Whereas if you make that mistake with commercial bank money, whether that's regular deposit format today or tokenized deposit in the future, then you still have that claim on the bank. You still have all of those consumer protections embedded in that, whether you're a consumer, a small business, or maybe even larger, etc. So I just think it needs to be really clear what you do and don't get so that you can make an educated choice. I think that's my main concern.
Yeah, and just on the point with competition, right, I think it is more of an environment where we're going to see multiple types of digital money that come to fruition and that potentially interoperate or at least are chosen based on the specific use cases. And if we just look at it from like just pure economics of these types of digital money and the requirements that they then get from a reserve backing and liquidity requirement point of view, there's an issue with fully one-to-one backed, all in high quality liquid assets, which is scalability. Commercial bank money is the most widely used form of money today. There are not enough short-term A-grade government debt instruments to cover that one-to-one backed, right? So I think that it doesn't mean that there's not going to be use cases for both, but it's also probably not going to be one to rule them all, as much as we need to consider at the end of the day, we build these solutions for, clients and use cases and keep that kind of pain point driven selection on the types of digital money that are then, being used. And I think the only other point to mention, this I guess is more of a stablecoins, but, if you are issuing a token on public chain, let's think about a stress scenario. Well, if this is public, we can actually have like totally publicly viewable records of like capital flight in stress scenarios, which could actually exacerbate that stress scenario and more capital flight because everyone's getting, kind of scared of what they're seeing on chain. It's completely transparent from that point of view as well. So I think like we need to think both at the level of kind of the protections that are required, but also what does this technology stand to do because it is frictionless and transparent in both senses. Yeah, and then the only last point I would say on that is from the deposit point of view, because it's more integrated within the bank ecosystems, you do have all of our BAU processes, quite a few that Peter pointed out too, but another one to think about is all of the stress testing, right, that's required from banks. Deposit taking is an incredibly regulated activity. So that kind of all of those regulations then translate to the same type of deposit token or any tokenized deposit or any deposit that's brought onto a new technology infrastructure, because we don't actually change the nature of the claim and the requirements that we need around those claims. Stress testing being one, liquidity and capital reserves, but also like AML, KYC, right, for our clients. And then there's going to be institutional clients who want those assurances and want to ensure that the spirit of these regulations and controls that we have in place are actually being, met as we bring this new form of digital money into what's largely this re-architecting of the financial space for distributed ledger-based solutions.
Yeah, just to add, because when Jón explained the concept, it sounded like that there was counterparty risk on the tokenized deposit, but not on the stablecoins. Just to correct this, I think on the e-money, there's also counterparty risk. I mean, Coinbase has an e-money license, so if you deposit your money with Coinbase, so therefore, no, it sounded like there's no counterparty risk, so there still is. And when we heard on the previous panel, you see for some stable coins, the reserves are concentrated in certain places. So I think to come back, as you all said, customers just need to understand what they're buying in. So if they buy a CBDC, they buy into a liability against the central bank. If they have commercial bank money, or if they have regulated stablecoins, just as a different risk profile, isn't it? So I think that's important.
Yeah, of course, there's a counterparty risk for e-money issuers. But what I was saying is that if you have a deposit, then you have a counterparty risk on one entity, right? You have on Lloyds or on JP Morgan or whatever. And you have all these stress tests, but still we have bank runs, right? And when we have 50,000 people working for the European Central Bank, and what are they doing? They are making sure that the banks won't go bankrupt, because banks are leveraged 10 times. They are highly risky. They're like hedge funds. And if they generate a loss, then they can wipe out the equity, and then everyone in society has a problem with their deposits. But the difference is that as an e-money institution, you have to keep the money in segregated account. It is not, you are not allowed to lend it out or invest or take any risks with it. You're not allowed to do that. And if you have it in high quality liquid assets, it's very clear what kind of assets that are. The diversification of counterparty risk is defined. And also, then if you want to improve the system, then it would be very easy to do so by simply allowing e-money institution, regulated and licensed e-money institutions, to safeguard with a central bank. And what does that mean? It means that you as a token holder, you have a claim not on the issuer, but on your money. If the issuer goes bankrupt, you have the claim on your money, which is not allowed to be used in anything else. And if it's kept in a central bank, then you have a claim on your money in the central bank. It will, I mean, with all respect, then that is more secure than Lloyds, and it's more secure than JP Morgan. So if we want to aim for the best, then deposits, have been the center of the banking problem for 110 years. It's not going to go away. We have a better solution. So my point is simply this. Let's just aim for a better solution for the society. I understand that, there's a lot of things at stake to maintain, the current system, but I think there is a better way. And with regards to liquidity, it's correct, Emma. You don't have endless supply of bills and so on. That is why it's important for central banks to be backing this kind of money, and that is actually what is happening. What is happening in England? I mean, Peter, you know this. The Bank of England basically announced in November last year that they will require significant issuers to hold their money at the central bank. So we are getting there. I don't think there's any competition. All I'm saying is that we are just moving towards a future where we have safer money, which is basically going to be run by private e-money institutions here in Europe. And hopefully, in Europe, it will also be backed by central banks, the underlying assets.
So just so we have a bit of a discussion. It's good, isn't it? No, I think just the question is, don't you make a case for CBDC then? Because when you say you want more stability, etc., so then don't you make the case for CBDCs?
So a CBDC is basically two things. It's either a retail CBDC or a wholesale CBDC. A retail CBDC is a nonsense in my mind, totally nonsense. Why? Because you are basically taking away the incentive of the private sector to innovate and to basically service the market. You don't want to do that. But wholesale CBDC is basically making sure that the underlying assets are safe and they are central banks. So I think the European Central Bank is making a huge mistake by just talking about retail CBDC, because it's discouraging investors to basically invest in European stablecoin projects. So no, I think retail CBDC is a no-go, but a wholesale CBDC is something that we should aim for.
Okay, now I understand your position. Thanks.
Turning it over a little bit to where you might see one form of the type of digital money that you guys are discussing excel in rather than another, because now we talked about the architecture behind them, some of the risks associated with them, but where do you see in real life, of course, there is actually an edge that tokenized deposits or deposit tokens have. Peter.
Yeah. Thank you. I think there's a number of use cases that tokenization can improve or enable across the retail to wholesale spectrum, actually. So if I think about the retail sort of spectrum, I think there's a lot of occasions when individuals want to do peer-to-peer transactions, but the risk is quite high. But the transaction is too small because to warrant setting up sort of an escrow process with a solicitor. But maybe new technology like tokenization could enable the deployment of escrow functionality to facilitate safer settlement for peer-to-peer transactions. So maybe we could have peer-to-peer with safe settlement, and we could enable that cohort of transactions, which unfortunately, certainly in the UK, account for over 50% of all of the instant payment fraud situations, is these purchase scams. If we could enable a new workflow with sort of programmable payments or payment versus delivery in that retail scenario where the funds could be locked and transparently shown to the seller, and the seller could then indicate who's the oracle for releasing that. That would be sort of the postal delivery agent, and that they could then sign that smart contract and release those funds, and that would be in a executed in a more transparent space, overseen by multiple people, not just one central authority that maybe not all parties can trust. That's quite an exciting one to explore, and you could expand that in the retail space to perhaps bigger transactions that are peer-to-peer, that do use solicitors, like the home buying journey, for instance. And maybe we start to, therefore, effectively the theme is bringing some of the benefits of this technology where we've kind of solved these issues in the wholesale space by setting up big pieces of infrastructure. Maybe this new technology could bring some of those safer settlement benefits of that big infrastructure tech to very small transactions. That'd be quite cool if we could do that.
Maybe I can, complement some of that answer, but more from the wholesale side. So, and actually comment on something that you asked, right, about adoption. So maybe I'll comment on adoption really quickly first, and then I promise it will make sense with what use cases and areas we feel like are driving this. So first, I would say from an adoption point of view, particularly in wholesale payments, high value payments, treasury flows, I mean, adoption is happening across the industry. JPM Coin, for example, which is really a blockchain deposit account, it's not a token or a coin, but it refers to to a blockchain deposit account. So what you would see your traditional account ledgers, right, that we would all have as banks, but really put on blockchain-based infrastructure that is, a subledger to make payments 24/7 in real time across the bank's global footprint. So as long as you are a client, of JPM in this case, you can open a blockchain deposit account and make those flows outside of any operating hour considerations 24/7 and in real time instantly. And when we think of adoption, I mean, this is live in 8 funding locations, Euro and USD, and we've recently reached the threshold of processing over 1 billion per day. So there is some adoption because it's driven by really clear pain points, right? In this kind of wholesale treasury flow, intraday repo flows, all of these different flows, we have considerations of our cost of capital, of our cost of liquidity, of our credit utilization requirements, and of total working capital that gets locked in flight for making these types of high-value global payments. So this has really been what's driven that kind of level of adoption. Now, I would say the next area that we're looking at, to the point of this panel, right, is looking at more of kind of tokenized deposit or deposit token projects. And I think a lot of these are either in development or in pilot, right? It's a little bit newer. But I think what's common across the two is that these are both really going to permeate the industry when they're driven by really clear pain points that our clients have and when they're the best technology solution to actually meet those pain points. So with deposit tokens, for example, I mean, ultimately with the types of clients that we deal with who are largely, trading regulated securities or doing high value payment flows, institutional payment flows, we saw a need for blockchain native stable digital money that could be a traditional deposit and could have the strength of the balance sheet, the strength of the controls procedures, a lot of the different things that we've discussed, but that can be issued natively on chain. Why? Because in, let's say, a delivery versus payment scenario, if you don't have a token that's issued on the very same ledger as the security token or tokenized security, you can't create atomic delivery versus payment. Why do we want to reach atomic delivery versus payment, which really refers to simultaneous and instantaneous delivery and payment movement? Because that's the only way to not reduce, but to actually eliminate counterparty risk, right? If one side of or one leg of the transaction fails, the other just simply won't execute. So you don't have the risk, you won't have the reconciliation requirements, etc. So this type of kind of driver is ultimately where we saw, well, actually this two-phase sync model does create risk. So we see a need to bring more efficient forms of stable digital money to fruition. The other example, and to Peter's point, right, payments, of course, is big because today payments require basically they require to be processed through various intermediaries, right? So there's different parties in the flows of making these payments, but also there's always a clearing or a messaging structure that's happening when we make a payment. Think of your ISO or your SWIFT messages, and then an end-of-day settlement across those payments, which if they're cross-border have to go across, complex networks of correspondence and then get finality into central bank money at the end, right? So this is a complex system from a functional process, but every single one of those steps have many siloed systems, right? And require data harmonization across those systems, require intercommunication across those systems. So we saw a need, again, in this case, to say, well, what if we could actually have a deposit token sitting on chain opposite maybe another token? And we actually piloted this in the first Project Guardian opposite an SBI Singapore dollar token, and we issued a Japanese yen token, and we're able to make an FX payment transaction as a payment versus payment instantly without any extra requirements to harmonize across different systems or go through our various complex webs of correspondence, just creating massive efficiency in the payment value chain that we could create. So I think ultimately where we see adoption, where we see uses, or where we see these portions of digital or types of digital money really having the largest benefit is just going to be driven by the use cases in which they can facilitate, and then also the appetite to the clients, right? I'm sure, Jón will probably mention that e-money, I'm sure, can deliver some of these use cases and benefits too in certain cases, but then I also think it's going to be, is the institutional client, ready to utilize e-money? Are they more comfortable with utilizing money that's backed as a claim on a specific bank that they already bank with and already have a depository relationships balance sheet? I mean, there's many different types of kind of questions at play that will help choose the type of digital money that's best suited for the use case at hand, because ultimately we're all trying to build, more efficient payment systems and infrastructure and safer payments and infrastructure. So that's what needs to be at the forefront.
I mean, we have John right here, so we can clearly ask him what he would say now. E-money tokens have a leg up on compared to other digital forms of money.
Yeah, e-money is basically, in general, it's basically what you use when you in Europe when you have a digital version of cash. It's a better instrument. It is not account-based, and this is huge. It's similar as cash, but it is fully traceable, which means that it's we can conduct money laundering procedures more efficiently than any bank, because banks basically they monitor where the payment is coming from and where it's going to, but in this system we have overview of the whole transactions. So I think there are just many use cases that we can do much better in this system, and I think we should embrace this new technology, try to improve the system. I'm not pretending that there are no trade-offs, and banks they have played a role in society. But it has to change in my mind, and there are a lot of problems with banks, and in particular connected to deposits. So I think we should take that seriously. But there is one issue with banks which we have to think about, which is not discussed a lot, which is that banks create most of the money in modern societies. And if we are moving in this direction, then that will diminish. Then we have to understand, okay, so how are we going to make sure that we create the money that we need, right? This is the discussion that should be being now had at the European Central Bank and central banks around the world, because this is a big issue. Because in my mind, it's inevitable. We're moving into a world which is going to be different. The roles of banks, it will change. That's a good thing. If we can eliminate too big to fail banks, I think that's good for society. It's maybe not good for those banks because it's a privilege, but I think it's healthy. It's good for competition. It's good for innovation, and we should aim for that. But there are other things that we have to consider. So I don't think it's an easy solution. There are trade-offs, and I really welcome this opportunity here to discuss it with these people from these banks, because this is important discussion that we need to have. And I'm sorry if I'm too frank about my opinion about the banks.
Okay. No, so maybe to come back to your original question, where do we stand in the adoption? I think that was the original question, and I think we agree banks will still exist. So, so I think it's not widely used. Yeah, I think so. I mean, JP Morgan is one example where you have provided multiple use cases on tokenized deposit. But if you look at the whole banking industry, it's still early days, I think. So, and I think one challenge is that, I mean, if we talk about payments, it's an integrated international global infrastructure which has been built. So therefore, I think we need many players to come together and basically build something. Otherwise, we end up in, let's say, in Europe, where we have, I don't know, 20 big banks with 20 different solutions. Plus, we have the e-money providers. So we have, at the end of the day, we have 30 different solutions which are offered. So this can't be the final vision for the payment industry, I think. So therefore, I still come back, and I had a presentation last time on the unified ledger idea, and I think Peter can more comment on that if he wants to. So I think somehow this needs to come together. That's my vision, that at the end of the day, all of these forms of money, only if they are regulated. So if they are regulated, and as you said, backed by central bank, backed by the central banks, somehow they need to come together in a unified form. So, and I think that's still a long way to go, I think. I think one of the key aspects we have in Europe is that, of course, this infrastructure is currently run by the central banks or the Euro system. So therefore, also they need to engage, and I think they are currently busy with the retail CBDC. So, so therefore, I think that the lack of adoption is not super great yet. But I agree, there are multiple initiatives. BIS has a lot of projects running, and a lot of banks are engaged in this discussion. But I think it's a way to go.
Thank you for those closing words, Jan. I'm sure you are happy to continue the discussion with anybody out there. And with that being said, it's concluding today's panel on the standoff between tokenized deposits and stablecoins.